Well, good morning, Bob.
Good morning, Bill.
This morning we're at the 2014 FNC Alpha Conference, and we're thinking about
The beach.
no, not the beach. We're thinking about everybody else. We're thinking about the beach, but everybody else is thinking about Chairman Yellen's comments to Congress this week.
Right, she's got an annual talk. She's presenting to the House Financial Services Committee tomorrow, and then to the Senate Banking Committee on Thursday. This is the Humphrey Hawkins presentation.
Everybody here will be thinking about that commentary later in the week.
Yeah, right. So anyway, she's going to basically give her first view of what she's going to be doing as the new Fed chair.
Well, the market has been reacting strangely to the Fed's tapering, because you would think that the 10-year rate would trend toward 3. In fact, a lot of speculators think it's going to go beyond 3, and yet the yield has not done that. It's come back down.
It keeps coming down, and the problem is the unemployment numbers are just not good, or the employment numbers are good. The unemployment rate keeps going down, but that's mostly for other reasons.
Well, there are lots of reasons that 10-year rate is trending down. Some of it's a flight to quality. There are markets around the world, emerging markets in Europe, not doing well.
They're having a lot of problems. Europe has taken some bad strategic moves in the way that they're managing their economy. And so they've got some real problems over there. They have this approach of austerity, which has not been useful, and as a result, they've had a lot of difficulty. And so, yeah, you're absolutely right. A lot of people are buying bonds.
Well, specifically U.S. Treasuries. So let's talk about the mortgage market in this country and the implications for some of our clients, some of the regulatory issues that have come to pass. We've just had some regulatory things take effect in January, some disclosures, new disclosures. The Consumer Financial Protection Bureau is all about disclosing things to the consumer. In fact, their big mantra is know before you owe.
Right.
It's flashed all over the webpage.
Yeah.
So let's talk about that.
Well, you know, a lot of it is uncertain at this point. We have the Dodd-Frank regulations.
And we're listening to Chris Dodd today.
Yeah, maybe he can give us some insight. But, you know, they passed
We had Barney Frank last year, and he said, I don't believe in following any law that I didn't vote for. So we'll see if Chris Dodd believes the same thing.
Right, yeah, and so...
He'd probably change, though, because he's now the CEO of the Motion Picture Association.
Right, doesn't like all those regulations. So anyway, right now, though, we're just starting to see how this is all going to play out, because we're just starting to have some of the inspections and trying to understand how they're going to actually enforce these laws. I saw in the Wall Street Journal this morning that the OCC is changing the way that they're going to be doing the regulations. They have had large staffs of examiners in the big banks, and they're thinking about pulling those out and having a small presence in the big banks, and then having the examiners focused on specific aspects of lending, and have teams of people that are going in and going from bank to bank, focusing on that. So it'll be a different strategy.
Well, you get specialized types of analyses when you do that,
Right?
as opposed to this broad brush.
Exactly. So we don't know if they're going to do that, but that's just one example. The other thing is that as the regulators are going into these banks, we're finding out what they're interested in, because they're all each going to have some type of agenda of things that they're specifically looking at. And so we're starting to get feedback from our clients about the types of things that they're looking at for, and how the bank is going to need to respond.
There are two general types, or camps, if you will, in the regulatory agencies. One, safety and soundness. In the 07, 08, 09, 10, 11, we had the safety and soundness regulators very concerned about will the banks survive. And so now that they've got their balance sheets healthy, we have another camp of examiners which really are on consumer regulation, the whole idea of compliance with consumer legislation. And it appears for the first time we're starting to see the consumer issues take front page, if you will, with the examiners.
Well, yeah, I mean, the examiners are following suit. We've certainly got the CFPB that's got their own agenda in terms of how they get that information out to the consumers. And that's going to be something that's just going to be revealed over the year, I think, in terms of where they're going with this. But we've been hearing cases where they're coming in full force, even to some fairly small banks, and really going heavy on all of the information that's being provided to the borrower.
The two big things that have changed, well, a lot of big things have changed, but two really big things have changed. The GFE, the good faith estimate's going away.
Right.
It's going to be a lending disclosure. And the HUD-1 is going away. This is, I think, August 15th. I believe the correct date if my coffee's working this morning. August 15th of 2015. And the HUD-1 is going away. We're going to go to basically a closing disclosure.
Yeah, I think that the impetus is to try and clean up a lot of those forms because, as we well know, there are a lot of variations of those forms, and what they're trying to do is
change right up until the borrower signs.
Exactly, and they're trying to streamline a lot of that and make it clear. Now, they've done, I mean, we've seen this before.
Well, they're doing more things as well. They're essentially moving to tracking everybody in that whole decision process that has any influence on that loan. They're going to be tracked, their license is going to be tracked, and that is going to be disclosed to the borrower.
Exactly, and I mean, that's some of the things we're seeing. How can you demonstrate that all of this is actually occurring? What's your documentation on this? What is your audit process for all of these different things? That's the kind of things they're looking for right now.
So is that just going to be an added cost? Is that going to mean less profit to the lender? Is it going to be a regulatory burden? Is it going to basically wind up costing the borrower more?
You would certainly think so. I mean, there's no question that it's going to require more oversight by the lender to make sure that these things are happening. And a lot of lenders are a little bit wary right now about all of the implications of this down the road because the sort of the climate is one of coming after the lenders for any violations of any of these things. So, yeah, certainly in the short run, I would think that it's going to have a significant impact in terms of their processing, slowing it down, making it more expensive.
I talked to a banker the other day who said, I just wanted to go back to the way it was.
Well, everybody does.
And so the question is, will it ever do that? Are we at a new normal, and will it stay at the new normal for some extended period?
I think it is going to reach a steady state where everybody has some common expectations.
Is that in 2020?
No, I think it'll be 2015, 2016 that people will say, okay, this is the new norm. And we'll be there and people will adjust to it. And then those will be the good old days.
Will the secondary market return, you think? Will we get some
Secondary
transparency?
market has got to return at some point. There's no question.
But we're talking about the private secondary market. There's been a GSE secondary
Right,
market.
yeah. I mean, it's going to come back. We're hearing right now on the loans that don't qualify under the new Dodd-Frank requirements are already there. People are talking about securitizing those, and that may be the way that it gets.
You're talking about a non-qualified mortgage.
Right.
And so the lenders we talk to, there's going to be a big market, we think, for education of the applicant. This whole idea of ability to repay is important in the institution. It's also going to represent an important educational opportunity for applicants. Because the idea being that, hey, this is the consumer issue. The applicant is uninformed and they need to know before they owe. That's CFPB's mantra.
Right. And that's a big challenge because first of all, a lot of times the borrower really doesn't want to know.
They just want to sign and get the house and
They
go
just
on.
want to get in the house and they just, whatever, take care of it. We just want to get into the house.
When I was younger, I remember looking at a mortgage, and it was basically only two forms. It was the note and the deed of trust.
Right.
And now the stack is 100 forms, several hundred pages and not literally 100 forms, but
Yeah, a lot of
euphemistically 100
documents,
forms.
yeah.
Exactly. And so as a result, we now have much more documentation, much more disclosure.
And much less reading.
And much less reading, and people just sign, and the way they go, and those documents change right up to closing.
Right.
Well, we're way over our time. We want to welcome you to FNC's Alpha 2014, and let's go to the beach.
There we go.